Let's record some inventory transactions. We can use our inventory example data. Let's make an entry for the sale on February 15th. Every inventory sale has two entries. The first entry records the sales price. This sale was for 125 units and the sales price was $25 each, for a total of $3,125. Let's assume this was a cash sale. We would debit cash for $3,125 and credit sales revenue for $3,125. The second entry records the inventory cost. If we are using FIFO and perpetual FIFO, the inventory cost for this sale is made up of 3 layers of inventory: 5 units at $8 each, 110 units at $10 each, and 10 units at $12 each. These 3 layers total $1,260. This is the inventory cost for that sale. We would debit cost of goods sold for $1,260 and credit inventory for $1,260. As a side note, this means we made a gross profit of $1,865. What about when we purchase inventory? On February the 22nd, we purchased 100 units at $13 each for a total of $1,300. If we paid cash, the entry for this purchase would be a debit to inventory for $1,300 and a credit to cash for $1,300. If we purchased this on account, we would debit inventory for $1,300 and credit accounts payable for $1,300. Maybe something we purchased is damaged, or we received the wrong item. We would need to return some of the inventory. Assume $100 of inventory that we purchased on February the 22nd was the wrong color and needs to be returned. If we had purchased these items with cash, we would get our money back, and we give the inventory back to the company we purchased it from. We would debit cash for $100 and credit inventory for $100. If we had purchased the inventory on account, we would no longer owe the $100 and we would give the inventory back. We would debit accounts payable for $100 and credit inventory for $100. Perhaps the company we purchased the inventory from offers a 10% discount if we pay within 10 days. We take advantage of the discount and pay within the discount period. Let's recap our purchase history. We originally purchased $1,300 of inventory. We then returned $100. So we currently owe $1,200. Our discount would be $120. So we would need to pay $1,080. The entry would be a debit to accounts payable for $1,200, a credit to cash for $1,080, and a credit to inventory for $120. Why do we credit inventory? Because the discount decreased the amount we paid, or the cost of the inventory. Another inventory consideration is that of freight or shipping charges. When you order inventory, it has to get to you. There are 2 options for shipping terms: FOB shipping point and FOB destination. These terms determine when title or ownership transfers from seller to buyer and who is responsible for the shipping charges. FOB stands for free on board. With FOB shipping point, title transfers when the item is shipped. Also, the buyer is responsible for shipping charges. With FOB destination, title transfers when the item reaches its destination. Here, the seller is responsible for shipping charges. Shipping charges paid by the buyer are referred to as freight in and are included in inventory costs. For example, if the inventory we purchased was FOB shipping point and we paid $150 for shipping, we would debit inventory for $150 and credit cash for $150. Shipping charges paid by the seller are referred to as freight out and are included in either cost of goods sold or as a selling expense. Well, that's all there is to know about inventory, right? Not quite. there's one more piece to the inventory puzzle.